Hi there, my name is Micciche, CEO of True North Retirement Advisors, where we specialize in retirement and exit planning for business owners. So today I just wanted to do a quick video because I have been having conversations with clients all the time who are scared out of their minds. They're very worried. When's the next recession coming? So I'm addressing today 5 reasons why I'm not so convinced that a recession is on the horizon. Okay, so let's get into it. I want to focus first and foremost on why the news media does what they do, which is they are trying to sell viewers. They want people to watch and keep watching, so they have to continue to parade out people who are coming on and talking about doom and gloom, the world's coming to an end, the sky is falling. It's in their best interest to do that. So it's really important when you watch business news, particularly when they bring someone who's very convincing about the impending doom that we are all facing, just keep in mind that they have their ulterior motive is to keep you watching, not to share with you logical, well-researched information, despite how convincing it may sound. When someone comes out and talks, they really do seem like they know what they're talking about and they found the crystal ball, and but they're just trying to sell you news and keep you watching. So I want to talk about 5 reasons why I don't think a recession is on the horizon and why you may still want to be positive about the direction of the economy. So here we go. Number 1 is housing starts. If you go back to August, a couple months ago, in August, housing starts were the highest they've been in 12 years. So here's why this matters. Housing starts is a very important leading indicator. Builders do not build homes if they do not think that they can sell that home quickly. So it's an important leading indicator and has been a very strong predictor of prior recessions, as the housing starts and building permits, which is data that's released monthly, when those start to deteriorate, it's a strong sign that a recession is probably on the near horizon. So it's a good leading indicator. And housing starts, like I've said, strongest they've been in the last 12 years. Okay, so we have the University of Michigan Consumer Sentiment Index. That's leading indicator number 2. And here's why this is important. The consumer, you and I, make up like 70% of the U.S. economy and economic output. When the consumer feels good, they spend more, they borrow, they generally keep the economy moving forward. And so the University of Michigan has a very popular well-documented index that they put out on I believe it's a monthly basis. And the most recent reading, it came in at 92. So anything above 90 is considered very popular or very positive indicator for continued growth. And then anything below 90 and between 70 and 90 is just sort of so-so. And then anything below 70 is like problems looming on the horizon. So the fact that we're still at 92, despite, everybody out there being so fearful, the consumer still feels pretty good and is well in the range of positive as far as pointing to the economy continuing to move in the right direction. Okay, next is the inverted yield curve. This has dominated the news along with the trade war with China, Mr. Trump and his Twitter feed. But the inverted yield curve is basically when short-term rates are higher than long-term rates, it signals that something is wrong, because it should be like this. Shorter-term rates should be lower than long-term rates. So when they invert like that, it's a sign for a lot of reasons that the economy may be slowing down. And every year since I think 1955, the yield curve has inverted prior to the start of a recession. So as soon as it inverted, all the news media, they brought everybody out saying, recession is here, recession is here. But historically, on average, it takes about 18 months from the time that the yield curve inverts to the start of the next recession. And historically, it's also taken as long as 3 years. So there's a lot of reasons why the current environment. The yield curve has inverted that we don't have a lot of time to get into today. But it's not the imminent sign that the news media would have you believe. So it is something to watch though. So keep an eye on the inverted yield curve. It's a really strong leading indicator and is predicted every recession going back about 60 years now, well, 65 years or so without fail. But it's not a sign that a recession is imminent. Okay, the other reason to be positive is if you look at profits of big business right now in the United States. If you look at the S&P 500 profitability, this is the earnings and profits of the 500 largest biggest behemoth companies in the United States. So pretty much every household name is in the S&P 500, and what's going on with those big businesses is a really strong indicator of the direction of the economy, because as their profits start to decline and dwindle, it's a really strong predictor that something bigger is going on within the economy. However, right now, most of the companies in the S&P 500 have now finished reporting their earnings for the second quarter of 2019. And across the board, the average year-over-year growth in profits was 5%. So not like massive growth in profitability, but it shows you that these companies and their profits are still moving in the right direction. Now, there's been some negative. A lot of the companies who are exposed internationally, who have been impacted by tariffs and the trade war with China, they have suffered a little bit, but despite that, on average, profitability of large U.S. businesses is still growing, and over 70% of the S&P 500 companies in the second quarter of 2019, they beat expectations on their earnings, meaning that they reported better earnings, stronger earnings than what they had forecast. So it's a really strong indicator that the economy and big businesses are still going in the right direction. And then the last reason, number 5, that's sort of connected to profits of big businesses and small businesses alike, is jobs. Now, companies are still hiring. The unemployment rate is still very low. The rate of job growth is slowing down because pretty much everybody who is employable has been hired at this point. So the pool of applicants is getting much smaller, and it's harder and harder for companies to find qualified applicants. So the rate of hiring in new jobs is slowing down, but counterbalancing that, we also are seeing more wage growth. So there's a lot of reasons to still be positive. I just want to summarize that we've got housing starts good, still strong. We've got consumer sentiment that is still strong. The inverted yield curve is something to keep a watch on, but it's not a sign that a recession is imminent. We have corporate S&P 500 corporate profitability is still strong. And then lastly, we have job growth. So here you have it, 5 reasons to remain positive in this kind of bipolar economic climate that we're in. One day we're up, it feels really good, then the next day it's doom and gloom. So until a lot of these leading indicators begin to sort of roll over and change, I don't really see a strong reason why we need to be negative about what's going on. But here's what I would say. Now is an excellent time to review your asset allocation, the mix of stocks and bonds that you have, because the time to be reducing your exposure to stocks is right now. When the stock market is strong, when the economy is strong, is a time to dial it back if it makes sense for you to do so. So if you have questions about your asset allocation and where you should be in this economic climate relative to your retirement portfolio, there's a link below where you can click on a time to schedule a free 15-minute call with me. Strategy call. What is your retirement strategy in this environment? Schedule a call with me and I can point you in the right direction for free. Thank you so much for watching. My name is Micciche, and I will see you next week.